Do you ever wonder why so many smart people lose money in the stock market? They're well educated, they work hard, they read the news, and yet, year after year, they fail to build real wealth. It's not because the stock market doesn't work. In fact, the stock market has created more millionaires than almost anything else in history. But the truth is, there are hidden wealth killers that slowly eat away at your money. And the scary part? Most people don't even realize they're falling into these traps until it's too late. In this video, we're going to uncover the 8 biggest wealth killers in the stock market. These are the mistakes that keep ordinary people broke while disciplined investors quietly grow rich. And here's why this matters. According to a study by Dalbar, the average investor in the US earned just 6.8% annually over the last 30 years, while the S&P 500 returned more than 10% annually. That gap might not sound huge, but over 30 years, it's the difference between retiring with $200,000 or retiring with over $600,000. So if you've ever felt frustrated because your investments don't grow as fast as you hoped, stay with me until the end. By the time you finish this video, you'll know the exact traps to avoid and the proven strategies that wealthy investors use instead. Let's get started with the first wealth killer. Wealth killer number 1, chasing hot stocks. Many people hear about a stock that's going to the moon and rush to buy it. By the time you've heard about it, it's often too late. One of the biggest mistakes people make in the stock market is chasing hot stocks. You've probably seen this happen. A stock is all over the news, everyone's talking about it, it's exploding upward, and you feel like if you don't jump in right now, you'll miss your chance to get rich. By the time you've heard about it, most of the gains are already gone. Let's take the meme stock craze of 2021 as an example. Companies like GameStop and AMC went viral. People on Reddit and TikTok were bragging about doubling or tripling their money. But what happened to the majority of those who bought late? They lost thousands of dollars when the hype faded. In fact, a study from the University of California showed that the average individual investor underperforms the market by about 3 to 4% per year, mostly because of bad timing decisions like this. Instead of chasing hype, build a long-term plan. Wealthy investors focus on businesses with solid fundamentals, not short-term excitement. A dollar-cost averaging strategy, where you invest a set amount regularly, beats chasing trends almost every time. So remember this, wealth is built over years, not overnight. Wealth killer number 2, trying to time the market. People think they can predict the perfect time to buy and sell. Data shows missing just a few good days can ruin your returns. Here's a harsh truth, almost nobody can time the market consistently. Not you, not me, not even the so-called experts. JP Morgan published a study that looked at market returns from 1999 to 2018. If you simply bought and held the S&P 500 during those 20 years, you earned about 5.6% annually. But if you missed just the 10 best days in the market, your returns dropped to 2% annually. That's the cost of trying to time the market wrong. And here's the kicker, 6 of the 10 best days happened within 2 weeks of the worst days. That means if you sold out after a crash to avoid pain, you almost certainly missed the recovery. Stop guessing. Use dollar-cost averaging. Invest steadily, month after month. This way, you buy at both highs and lows, and over time, your average cost goes down. Consistency beats prediction every time. Wealth killer number 3, lack of diversification. Putting all your eggs in one basket. One bad company or sector can destroy your wealth. We've all heard the saying, don't put all your eggs in one basket, but many investors still do it. Take Enron. In 2001, Enron was one of the biggest companies in the US. Thousands of employees invested their retirement savings in company stock. When Enron collapsed, people lost their jobs and their life savings in one blow. Diversification protects you. By spreading your money across different stocks, sectors, and even asset classes like bonds or real estate, you reduce the risk of one disaster wiping you out. Index funds, or ETFs. Instead of betting on one company, you own a piece of hundreds. It's simple, low cost, and proven to work. Wealth killer number 4, emotional investing. Fear and greed drive bad decisions. Most investors underperform because they panic. When markets crash, fear takes over. In March 2020, when COVID hit, the stock market dropped over 30% in weeks. Many panicked and sold at the bottom. Yet just months later, the market had fully recovered, and then went on to reach record highs. The average investor earns less than the market because they buy high when excited and sell low when scared. Control your emotions. Have a written investment plan. Stick to it even when your emotions scream otherwise. Wealth is built by patience, not panic. Wealth killer number 5. Overtrading and high fees. Constant buying and selling kills returns. Fees add up faster than you think. Every time you trade, you pay, either in commissions, taxes, or lost opportunities. A study from Barber and Odean showed that frequent traders underperformed the market by 6.5% annually. Why? Because fees and taxes ate away their returns. Keep it simple. Buy quality investments, hold them long-term, and keep costs low. That's why index funds and ETFs are so popular among millionaires. Wealth killer number 6. Ignoring risk management. Overconfidence leads to big losses. Leverage wipes people out. Some investors borrow money to invest, thinking they'll double their profits, but leverage also doubles your losses. During the 2008 crash, many margin traders lost everything because they didn't manage risk. Only invest money you can afford to leave for years. Use position sizing. Never bet everything on one trade. Remember, survival is the key to building wealth. Wealth killer number 7. Following the crowd. Herd mentality leads to bubbles. Everyone piles in right before the crash. Think back to the dot-com bubble. Everyone believed internet stocks would only go up. People invested blindly in companies with no profits. When the bubble burst, trillions of dollars vanished. Do your own research. Don't invest just because everyone else is. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." That advice still works. Wealth killer number 8. Not having a plan. Without a strategy, you drift. Random investing leads to random results. Most investors don't have a written plan. They buy when they feel good, sell when they're scared, and hope for the best. But hope is not a strategy. Data shows investors with a clear written plan outperform those who don't. Write down your goals, time horizon, and strategy. Automate your investments so discipline doesn't rely on willpower. Build wealth with intention, not guesswork. Avoid these 8 wealth killer mistakes, and you'll already be ahead of most investors. Remember, wealth in the stock market isn't about luck. It's about discipline, patience, and avoiding the mistakes that drain everyone else's money. If you got value from this video, make sure to subscribe, hit the like button, and share this with a friend who's investing. And let me know in the comments, which of these 8 wealth killers have you struggled with the most? Thanks for watching, and I'll see you in the next one.